Today's Triple Take, well, it's focused on the war in Ukraine and the global response. Romain, you've been trying to amalgamate what is a vast array of sanctions.
Yeah, and I mean, we've been talking about kind of how do you sort of keep track of all this. Of course, we know the U.S. imposed sanctions. It kind of came in different phases or tranches, if you will. Probably the most significant, of course, is what we learned in the last 24 hours. Of course, the sanctions directly against the Russian central bank. That effectively freezes any assets here in the United States. Basically, they're not going anywhere until the U.S. says they are. Of course, you got sanctions out of the UK. I thought some of the more significant sanctions, though, were out of EU, even though they were effectively the same as the U.S. The fact that now you're seeing the European nations more united here in pushing back, not only the ban on Russian transactions out of the central bank there, but of course you talk about the closing of EU airspace, which is huge here. And then there are a lot of other things that crack down some of the state-owned media companies. You wonder sort of what the broader effect is, not only on the economic issues with regards to Russia, but whether it actually has a political ramification for Putin where he would change his stance.
Let's discuss all this with the expert. The impact, of course, on those sanctions, on the Russian economy, on markets. Mayra Rodriguez Valladares, an expert, of course, on Russia and Soviet studies and a managing principal at MRV Associates. And we take a look at your history, dating back to some of the expert analysis you have of 1998, a Russian default, a long-term capital management blow-up. We have a Russian ruble volatility that is similar to levels that we haven't seen since then. Do the sanctions that you've seen in the last 48 hours, the impact on the Russian economy, do those look similar? What are you looking for when you take a look at the impact on the economy?
Well, what's truly different is the travesty of the invasion against Ukraine, right? What had happened back in the events that led up to the 1998 Russian default was the war against Chechnya. And so those were that was a pretty detrimental war in terms of the economy. Here you have a different situation. Yes, you have an unprecedented, horrifying invasion. But what you have is a very strong statement from the U.S. Treasury saying we're freezing your assets. They did that on a Monday when the markets are opening, and so you're sending all the important signals globally. And you also have, importantly, not just sanctions from the European Union. You have Switzerland, which traditionally is neutral, so that also sends a very strong signal. But here, what's also very different from 1998 is that you have a very involved private sector. You have some key corporates that are saying we're divesting, and that hurts their pockets, but they're divesting. You have sovereign wealth funds. Norway announced early on today that they would withdraw. And so if you start to have more sovereign wealth funds, important asset managers say, you know what, we're going to work in concert with different treasuries around the world, I think you will see even more of an effect.
You're, of course, over at MRV Associates, sort of consulting businesses, helping them understand some of the risk management that they need, the commodity markets implications, that sort of thing. How have lessons been learned from previous episodes? Have companies protected themselves to a certain degree? Will this happen again, or is this time it different?
You know, that's a great question. I think that when you talk about asset managers, huge financial institutions like the big globally systemically important banks, certainly the energy companies, they have not only much more sophisticated asset liability management strategies, but they also have financial derivatives. And so they certainly, many of them, in fact, will, I hate to say it, will make a lot of money, which I know one doesn't want to talk about that in the middle of a horrible tragedy. But a lot of commodity traders, really thrive in chaos, actually.
I'm curious, though, how integrated is Russia really into the global economy? Because I know we make a big deal of it. Obviously, they're an important player, definitely when it comes to energy and commodities here. But is it as intricate as maybe, say, a China or some of the other nations that maybe we kind of talk about that we can't sort of unlove?
And you really are hitting the nail on the head. That's right. I mean, we're talking about a country that represents less than 2% of global GDP. Of course, the story with Russia is commodities, commodities, and more commodities. It's not just oil and natural gas. It's platinum, palladium, it's oil. And yes, it's interconnected to the world economy, but not as much as we think. It's not China. It's not Brazil even.
Well, the reason I bring that up, because during the default back in the 90s, there was a lot of concerns about contagion.
Right.
And that's why you saw the IMF and the World Bank sort of step in and try to sort of, keep the worst from happening. Is there a need for that? I mean, can you have a default in Russia and not have broader ripple effects in the markets. Can we withstand that?
It's hard. I think that the U.S. certainly can withstand it. I also think that Europe can withstand it. But there is a lot of volatility because of the uncertainty, right? And people really almost have to take a deep breath and say, wait a minute. Russia is a very small player in foreign exchange markets. It has a very illiquid currency. It is very small in terms of GDP. American banks' exposure to Russia is incredibly small. Yeah. American banks are much more exposed to the UK, Japan, Germany, Mexico, Brazil, China, as you mentioned.